Good afternoon, everyone. My name is Al Alvarez. I'm the program director at Greater Newark uh, Enterprises Corporation, now known as GNEC. So I won't be saying Greater Newark Enterprises Corporation. You'll know us as GNEC because I know Heidi will kill me if I keep going back. I have the pleasure to be working with two great people on for this webinar with you. Um, Representatives from TD Bank, and I'll let him introduce himself. His name is Tom Locopolos. He's going to, I hope I pronounced it correctly,
Perfect.
and he's going to walk you through the presentation deck. And then Heidi is my colleague. She's our director of communications. And what I'd like to do now is hand it over to Tom.
Hi,
Take it away,
everyone.
Tom.
Tom Lukopoulos, TD Bank. I'm a commercial relationship manager. So as your businesses continue to grow, obviously I've had experience with small businesses, but as your businesses continue to grow and become more and more sophisticated, TD Bank takes a holistic approach to banking, and we'd like to get involved and become your partner and help you with all phases of the cash flow cycle. And we're going to be discussing cash flow today because a lot of people tend to think of banks as a place to go and borrow money from, but in reality, you can see cash flow benefits purely by optimizing your transactions. Um, we can get into that at some other time, but that's kind of what I specialize in. But today we're going to be going through really the three. We're going to present four financial statements, but really there's three of them that every business owner should be familiar with. So why don't we get started? Here's what we're going to go through today: managing cash flow. So it's going to be, in order to help really drive your understanding of what's happening in your business, and sort of looking at the past, understanding what happened, and being able to predict relatively the future, and how you need to pivot in the future to make sure that you have enough cash flow to continue running the business. So we're going to run through the balance sheet, the income statement, the cash flow statement, and the statement of owner's equity. By the way, just a real quick, the balance sheet is a point in time. So that's kind of important to understand. So when you pull a balance sheet, that represents the current state of all of your accounts in your general ledger as of that moment. And if you looked at it yesterday, it would be different. You looked, well, not necessarily, but it would be a different day versus looking at it tomorrow. The income statement, by the way, is over a period of time, and that can be anywhere from a monthly period to the full year. And then the cash flow statement reconciles really the balance sheet and the income statement. It kind of shows how the balance sheet balances changed during that period by looking at the income statement. So we're also going to be discussing forecasting your operating cash flow, and then we will have some important resources, really links that'll be at the end of the slideshow, and Heidi's going to be sending out, I think, some of those links later on. So obviously you can't click on the links here. So why don't we get started? Cash flow. 82% of business failures are due to poor cash flow management or poor understanding of how cash flow contributes to business. And, really understanding the next day and where cash is going to flow out to, is obviously super important, because it's just like, budgeting in your own life. And I think you can draw many parallels in your own life. And so you need to have that same level of understanding to your business, because, in many situations, your business is much more complicated with the number of vendors and the sources of cash and the uses of cash. Just real quick, you guys can all see the definition here. What is cash flow? The net amount of cash and cash equivalents being transferred into and out of a business At the most fundamental level, a company's ability to create value is determined by its ability to generate positive cash flows. And just a real quick point here, cash and cash equivalents. So, uh, you know, anything that can very quickly be converted to cash. So if you have, certain types of bonds, or even if you have equity in real estate, or some kind of equipment, that's not considered cash, regardless of how much equity you might have in something. So it's truly, what can be converted to cash pretty much instantaneously. So you need to think about it that way. All right. How do you run a more profitable company? Do you understand your company's cash flow and balance sheet? Do you review your financial documents? Do you actually understand your financial documents? And more importantly, this is where we get into that cash flow cycle, right? Is understanding your accounts receivable turnover and your accounts payable turnover. Your receivables are money, effectively money owed to you by your customers. You've booked the revenue, like you've booked the sale, and if you've given terms to your customer, let's say you have 30-day terms, but on the payable side, you have to pay your vendor within 15 days. Now you're going to have cash going out the door before you've received any money from your customer. And we've seen scenarios where a business has difficulty, staying in business despite having all this money that's owed to them, because they can't pay their bills. And once you can't pay your bills, your vendors cut you off, and you can't buy any more inventory or raw materials, or pay your people, and so the business has to shut down. And that's an unfortunate way. So that's why it's very important to understand the timing of your receivables versus your payables. Again, this is all very high level that I'm going to be going through. If you want to dive into anything more specifically, please feel free to ask me a question. I encourage you to jump in the middle of this, because it's kind of awkward just talking into on camera and looking at a screen. So feel free to jump out with any questions, please. Anyone have any questions right now about receivables or payables? All right. We'll keep moving. The 4 statements that we're going to be looking at today: the balance sheet, the statement of owner's equity, the income statement, which a lot of people refer to as the profit and loss statement, and the cash flow statement. So, balance sheet indicates the cash position of the business and what the owner's equity is at any given point of time. So remember, it's the day that it was written up. So if we looked at a balance sheet on June 30th versus a balance sheet on, December 30th, it's going to, it may be exactly the same if you had nothing happen on the income statement during that time period, right? And just remember, the time period for the income statement is over that time period. So in other words, your profits, losses accumulate. So your sales accumulate, your revenues accumulate over that time period. So it's important to make the distinction between a balance sheet being a point in time. This is what things look like on that very day, versus over a period of time. If you made a sale in January, and then another one in February, then another one in March, all of those things add up. So, and then the statement of owner's equities is really, and we'll get to this when we look at the balance sheet, assets minus liabilities is your owner's equity. And to think about it from the perspective of an individual homeowner, in essence, when you think about the equity of on a home, or maybe your car, right? You have the value of the home, the total asset, minus the mortgage, right? And then whatever's left is the equity. And we can look at your business assets in a similar fashion. We'll have, the cash at the top, the assets that you own, which can include a number of things, right? It's not just, it's not just, a car or a piece of equipment, or even the property that your business owns, but it can be your raw materials. It can be your finished inventory. In many cases, it can even be intellectual property, but that's that's not tangible. Anyway, and then we've got the cash flow statement, which really helps to show us where the actual cash is going. So we'll dive into all of those. Okay. In a nutshell, income statement is the revenues minus expenses is your net income. We all, for the most part, understand that, I imagine. And then the statement of owner's equity is affected by your net income, right? You have a certain value of your overall equity in the business. Again, going back to that mortgage example, if you will, let's say that your, I guess there was some addition made to your house or something, and it raised the value of that equity. In this situation, for your business, you're earning net income, right? So that equity is growing. Anything that you distribute out of your business in the form of a dividend obviously reduces that equity. So the beginner stockholders' equity plus net income minus dividends is the ending stockholders' equity. The cash flow statement, we'll get into some of the specifics there, but effectively operating, investing, and financing, we kind of break down the way that cash moves into three different buckets or three different operations, if you will. And then the balance sheet that is the snapshot of where your business currently stands. Let's get into some of the details here. So we have the balance sheet. Assets, you have your current assets, as we discussed before. Those are, like we said, anything that can be converted into cash pretty readily. You have the, cash and cash equivalents. Then we have current assets, which we didn't define before, but current assets would be something like your accounts receivables, anything that will be able to become cash within the current year. Real estate, right, or a car isn't considered a current asset because those are, sort of long-term sales, long-term, hold assets. So those would be, long-term assets or non-current assets. Just because the sales cycles for those tend to be a little bit longer, or the life cycle of those tend to be a little bit longer. And we kind of take the same concept and apply it into liabilities. So you owe a third party, you have your accounts payables, bills, et cetera, that are owed within the current year, lines of credits, let's say to a bank, or even, I'm sorry, any kind of, short-lived payment that you're going to need to make, as opposed to I'm sorry, the current period of, let's say, like a loan. Like, let's say you had a mortgage on a property, or you had like a 5-year loan on a truck or a vehicle or a piece of equipment. That current year, all of those liabilities or that total of payments that are required to be made in that year would be considered current liabilities, and the remainder of that loan would be a non-current liability. And then, of course, assets minus liabilities equals owner's equity. You guys have any questions here? Great. Let's continue. Here's a balance sheet. So hopefully it's pretty self-explanatory, where we have the totals of the assets. You may see this in a more of a vertical fashion, where the assets will be at the top, then the liabilities will be presented just after, and then the summation being the owner's equity. So it kind of looks like it's really just a basic math problem. And what really, I guess, is distinguishing between different types of businesses are the individual line items. What within cash? What is within your equipment or non-current assets? Remember, those things all sort of total up into that high level of current assets, non-current assets, current liabilities, non-current liabilities. But individually, it's up to you and your accountant as to how you define those individual, line items. Income or profit and loss statement. Okay, so at the very top, product sales, your services, et cetera. And when it says other earnings, it really means other earnings related to the operations of your business. And when we get into the cash flow statement, you'll see that you can earn money from the sale of equipment. You can earn money from the sale of some kind of an investment, or even have cash come in from, and again, we'll get all to this later, or even have cash come in from an investor, or from even a line of credit, right? All of those are considered not part of your normal operations, and therefore they would not be considered revenue. Obviously, very important that you discuss these things with your accountant. And we have certain expenses, direct and indirect. So the best way to describe your direct expenses versus your indirect is the costs of goods sold. So these are the costs specifically related to the product that you are selling. So again, if we can just make an example of widgets, for instance, you have raw materials. If you're making your product out of wood, the cost of the wood would be included in costs of goods sold, as would your labor, right? To get that wood into its final form. Indirect costs are kind of those everyday expenses that you have to run the business. Things like an accounting fee, or your rent, any kind of, I don't know, subscriptions, anything that just is not going specifically or directly into your product, into your widget. Now, as you get into tax returns or your financial statements prepared by your accountant, there are conversations that you should be having as to how to define what is direct and indirect. And so those subtleties, help you with what you are able to write off. And really, it ultimately all flows down into your profits. So very important to consider how you define an expense, or even a revenue. What is considered revenue versus what is considered some kind of a financing cost. So this is where accountants really, and accounting experts really come into focus here, as a necessary part of what you do with your business. I'm hoping you all have accountants.
Yeah, if I can just mention something, and I did post it as a note in the chat box, that we at GNEC have the Backstop program, and there's a track which provides the participants, once they're enrolled, with access to a bookkeeper, and they can certainly help you arrive at all of these items. If you're interested in learning more about that, please reach out to us. A lot of information is being shared with you today. A couple of key points also that you might want to consider is you need to really know and understand what your break-even point is, so that you're able to properly price the products. And also, I'm not sure, Tom, if you're going to go through some of the tax things, but as I understand it, the IRS, if you are showing more expenses that you have than what you have as revenue, they may deny some of the things that your bookkeeper or accountant puts out as deductions and things like that, because they will consider that to be a hobby. So you have to understand that you don't want to run a hobby. If you're in business, you're out there to at least meet the break-even point and make a profit.
So that's a great resource that you guys offer. You know, obviously there's a ton of information on the GNEC website. The one thing that I want to say is all of these are up for debate. I mean, really, expenses, the revenues, et cetera. And even, by the way, Al, the hobby business definition. I remember someone once said, you know, it's all about the intent. If you intend to make a profit, then it's a legitimate business. And there are businesses that have gone for, you know, 15, 20 years in a research phase and have just continued to expense, you know, a significant portion of, or the percentage of revenues, right, would actually exceed, or I'm sorry, the expenses exceed their revenues. And so it really comes down to, you know, working with your accountant to understand how everything qualifies. And I think the IRS and you know, investors in general understand that many cases there is a lot of expense that goes into researching the sale of a product. So work with your accountant to help understand that. So I just want to, you know, point out that, you know, it's not a clear and fast rule on any of these, including whether it's a hobby or a business that's losing money. So you know, make sure you consult with proper authorities. Now, the revenues minus expenses equals profit. And going back to Al's comment, and I, you know, just want to touch on this briefly as far as like a break-even point. When you're looking at your costs of goods sold, it's important to understand that, you know, it's not simply the cost of the materials and the labor that's going into your product that's going to determine whether or not you're going to make a profit, because you always have to consider the indirect costs as well, because those indirect costs are included in that total of expenses that is subtracted from your revenues to equal your profit. So what I mean by that is, just as an example, you know, let's say your wood costs, you know, you're selling your product for $10, the wood costs $5 and the labor costs $4, and you're only making $1 in profit, but you still have to pay rent. You still have to pay, you know, some supporting salary, maybe someone who's collecting your accounts receivables. You still have to pay for marketing and all of that other stuff. If all of that adds up to $1.50, and your expenses then are $10.50, but you're only selling your product at $10, you're not breaking even. So it's very important to consider all of those factors, you know, both your direct and indirect costs, in understanding how to price your services or your widget when you're selling it. All right, moving on. Here's a little bit more detail on those, you know, revenues and expenses. And again, I want to point out, you know, the kitchen rentals, the raw materials, you know, online, you know, the website, you know, how many of these things with your accountant do you feel fall into a direct product cost of goods sold, or are your indirect expenses? And here we're doing an analysis, by the way, of the previous year versus the current year. And, you know, it's important to understand how things changed. You're looking at the previous year. In this example, their revenues are lower. Why were the revenues lower? And so when you start to break things down on individual line items, you can begin to see where those changes occur, and therefore you can be able to, you know, make a plan as to, you know, how to move forward. Cash flow statement. All incoming sales and revenue streams. So this is going to versus all the total cash payments and your net cash flow. So like I was saying before, you may have income, or let's define it better. You may have cash that comes into your business that is related to revenues, but also related to other types of inflows, and those can be an investment from an outside investor, an investment from you as the owner into the business, lines of credits, etc. That could all be coming in addition to what you're getting from your customers as revenue. And again, you can define any kind of outbound cash transactions, and they're not necessarily they're not counted as costs or even costs of running the business as indirect costs. Those could be financing costs, things like interest payments, right? Don't necessarily, well, I mean, those depending on what they are can count in both operations of the business or as financing costs. So again, important to consult with your accountant, but just understand that there are certain definitions related to where you put those in the line item, and overall they can affect your opening and closing cash balances and how your profits are viewed on the income statement. But everything that happens between the income statement and the balance sheet will show up here on the cash flow statement. Here we get into an example of individual line items. So this will be available later on for you to be able to use when you see it. These various line items won't all be detailed here, and you can put in your own detail, but I just want to point out a few things. The direct costs, and again, this is all open to your own interpretation, but your materials, stock here, I imagine means, finished product, packaging. And remember, if you're selling your product, it's got to ship out in something, or you want it to look good on the store shelf. So, little things like that all get considered into the costs. And again, labor might be included in the other. Most businesses, most accountants will break out that labor, and there may be various types of labor that you might want to detail. Because again, this helps provide insight into your business. If you have a specific type of finishing to your product, paint versus someone who's, carving that piece of wood, and one takes longer than the other, or one is more expensive or more skilled than the other, you're going to want to get into that detail. So, you need to decide what level of detail you want to be able to analyze your business, but it's important to consider all of those. And then you get into the general expenses, the accounting, the bank fees, postage, right? Shipping costs, interest on loans, electrical power to run the business. All of those things, fall in here. Now, I also want to point out something else. You have repairs and maintenance, and again, important consideration with your accountant. How many of those repairs, not necessarily the maintenance, but how many of those repairs, whether it's to equipment or your property, count as capital improvements, right? Are you installing a new air conditioning system versus versus just replacing a part within the air conditioning system? So all of those are important considerations when you're looking at what your overall net cash flow is going to be, and your profit at the end. Your revenues and receipts. So here's where we get into the timing of some of those revenues and how they're booked. I think, historically, when you're looking at it, you should be able to just, book when you receive. So book the revenues when you are receiving the payments. And if you have, do any of you offer terms to your customers? And by terms, I mean, do you give them the product or the service and then allow them to pay later? Any other
Yes,
people here?
net 30.
So you do net 30? Okay, Liam. Anyone else? or are you cash and carry? All right. So in this scenario, it's important to understand when the cash is coming in. So, Liam, especially for you, you may want to understand, if you're doing a lot of projects around the beginning of the year or end of the year. I know some IT companies, their customers set up a budget, right, of when they're going to act. And so once the budget is approved, they're able to go out and start placing orders and, uh, getting their services booked. And so, you may be front loaded at the beginning of the year and have your people out doing or providing the service or even selling, computers or switches or whatever, it is that you sell. And so you may have several expenses up front, but you may not actually book, uh, the sale until you've completed the installation, and you may not receive the cash for a few months later. So it's important to consider the timing when you're filling out these forms.
Yes, I always have to have significant cash on hand in order to cover expenses until I get paid by the clients.
Yep. That's the cash flow gap. All right. So the expenses, same thing. It's important to have accurate figures. Very important to pay attention to where you're placing costs, whether they're direct or indirect, and then when you're getting or when that cash has to go out. Things such as your salaries to your employees, maybe weekly or every other week, and it's important to consider that that cash is coming out on that regular basis, whereas something like your accounting may only come out once a year. Um, or your registration for a vehicle versus having to pay for fuel for that vehicle, right? So it's really important to consider and estimate the timing of those payments, because that's going to ultimately help you figure out what your month to month uh, actual cash usage is going to be. Here's something that's interesting to do, and um, I like to do it with a lot of the organizations that I work with, is the percent of the dollar volume that's part of your overall revenues. So sales and revenue, what percent of dollar volume is generated from marketing activities? And so is it time for the business to shop for a new supplier or source differently using month over month and year over year comparisons? So you could see as a percentage of revenues what your marketing is or what your fuel costs are, et cetera. And then you can compare that to the prior year, and you can see whether or not it makes sense. If those percentages are increasing rapidly or decreasing rapidly, it helps you understand where the changes are occurring within your company, and um, where you should make changes, whether it's increasing fuel costs, um, and it's important to really see that the comparison on a percentage basis, right, is able to be made from really any year, because percentages are just that. They make comparisons, they make comparisons easy to happen versus having to look at not an arbitrary number, but a number that doesn't necessarily um, look look to be similar. You could have $25,000 dollars of marketing expense versus $100,000 in revenue, or you could have $2,500 of marketing expense versus $10,000 in revenue, and you might freak out and say, "Oh my gosh, I spent $25,000 versus my $2,500 last year." But when you realize that your sales are 10 times greater, they're still both represent 25%. It's all in line, so things look good. That's kind of what I meant by that. Does anyone have an issue with that or a question related to just, how I presented that? No? Okay, great. So the cash flow statement, if you're filling it out on a monthly basis or even a yearly basis, right? You obviously can go back and forth to the present time versus the past and really understand where things are moving. It helps to show us a trend in your cash income and your usage. Liam, this would something that would be interesting for you to help understand if there is seasonality around when those contracts are awarded, and your customers, and again, I'm kind of speaking from experience where I've had customers in the IT space that tend to book their contracts right after the budgets are set in November. um, November, December, as they start planning for the next year, and they award those contracts, and a lot of the services begin in January and February, and you get paid relatively soon. But then as things start to progress towards the end of the year and budgets are used up, things tend to slow down. So it's important for you to understand that seasonality. Maybe your business operates around the holidays, and so you start to see a run up of cash that needs to go out to help you buy the raw materials to manufacture your goods that are going to sell in November in the run up to the holiday season. So that means you're not receiving your cash until, December or even January from your customers. But you've had to lay out all this cash. And those are things that you can understand by looking at the cash flow statement month to month. And then, even year to year, so that you can start looking at broader trends. Again, it's the trends that are important, so you can start looking at the broader trends. um, you know Maybe your business is affected by seasonality from one year to the next, a hot summer versus a cold summer, um, an extremely precipitous winter versus one that everyone is able to go out and enjoy sunny, cool weather in the winter. So year to year, you can help to understand what the effects are on your business. Yeah.
Tom,
Yes.
just want to mention, just want to do a time check. We have probably another 4 slides to go
Yes.
of the presentation. Just want to let everybody know, if you can stay with us, we'll be glad to go through it. Just remember that this presentation is being recorded, and it'll be sent out to you as well. But I'm sorry to interrupt you, Tom. Go ahead.
No problem. So this kind of goes into the seasonal business fluctuations, and again, this could be on a month to month basis or even over year to year comparison. So really things that you should consider. Here are some more what if questions. What if you hire a full-time salesperson? When you consider what their salary is going to be over the course of the year, or even the fact that you're going to have to make a monthly or a biweekly or even a weekly payment to that person, how is it going to affect your cash flow? Liam, when the customers pay you 30 days later versus the fact that this person has to be paid and is going to provide future revenue, but is going to cost you money today, right? If you're working on a bigger project than you were last year or even last month. What happens if you borrow money? That interest payment is due every month. Um, if you add new equipment, that new equipment hopefully will generate cash in the near term, and is going to be generating by producing equipment or by producing product for you more efficiently, or allowing you to service more customers, right? So these are all key considerations. There's a lot of subtleties in answering these questions. So again, sit down with an expert in helping you understand the overall knock-on effects of making these decisions. Operating cash flows. So this kind of speaks to a few of the themes that we spoke to before. It's all about revenue coming into your business. That's the myth. It's really about how cash flows through your business. This helps speak to the, those employee costs up front, those every day or monthly costs related to the production of um, your product, right? And all of those things are coming out, whether it's daily, weekly, or monthly, versus when your customers pay you. I mean, there are businesses that get immediate cash flow. You bake something in the morning for, a bakery. You bake something in the morning, and maybe you have your flour and some of your raw materials delivered in the morning, and by the end of the day you've sold out of everything and you've received cash payment immediately. Those, in that scenario, your operating cash flow, you don't need to make those as much of a cash flow consideration. So you really need to think about, not just timing, but the types of expenses. This kind of goes into, again, really the timing, helping to figure out, will making an equipment purchase, help my business today versus, for cash flow to come in because I'm producing more, versus cash going out because I need to actually pay for that piece of equipment, right? So a lot of things to consider. Investments from outside, those are going to immediately fund new projects, maybe a new product line, et cetera. But when do you need to pay that investor? Do you need to pay them on an annual basis? Will you need to pay them, monthly to help them earn a return on their money? Or is it, 5-year interest-free loan, and you pay them one lump sum at the end that you're, setting money aside, profits aside as savings. So, all key considerations. So we have a few resources available to you. You obviously consult with your accountant and your financial coaches. There are resources through GNEC that you have available that can help you to make all of those decisions. I think that one key thing that you can understand from the presentation today is just how many subtleties there are in determining, um, you know, where the cash is coming from, and how to plan for your usage and your sources of cash. So it's very helpful to work with someone like GNEC. We do have some sample financial statements available, and I'll provide links to those. Those are here through TD Bank. And again, we're going to send this around. GNEC has a wealth of information available as well. And of course, I'm available for questions right now. So what do you guys have? Go ahead, Liam. Looks like you're unmuted.
Oh, yeah, I was just saying I don't have any questions, but, do appreciate this. Certainly I've been in business for, like 22 years, but I just rely on what my, accountant tells me, and it's very helpful to have a little bit more knowledge about the financials of the company without relying solely on a advisor.
Agreed. Yeah. As long as you can understand these three statements and the impact on your business, that makes you a better owner, because yeah, as a business owner, it's not just about your expertise in your product or service. It's really about your ability to, run the company, understand what broader economic impact there is on your company, right? Everything from, the price of your raw materials to, the market rate that you can, sell your services or your product at. So, um, there's another course that we've done about being able to, price your product and research the market for your product, and that's available on the GNEC website as well. So look that up. If you take one thing away from all this, that's to really understand. I would say start kind of at a high level on where your cash is going, annually, and then start to break it down at minimum on a monthly basis. um, and then really start looking at what, some of your expenses are. How many of you have employees on this call?
I do.
Okay.
Yes, I do
Javed?
too. Yep.
Great. And how often do you pay your employees?
Every 2 weeks.
Okay, great.
Same.
Do you guys have any expenses that you would consider weekly?
No,
No,
cancel
I don't think so.
you know, bi-weekly or monthly.
Okay, great. So when you do this
Yeah.
analysis, at least try and get it down to a monthly, a monthly look at where your cash is going, and really use that to help you forecast. First understand what it's looked like in the past, understand what that trend is, and then that trend can help you with what the future is going to look like.
And just a quick commercial, guys, from GNEX's perspective, we work with TD Bank a lot. And if you're interested in our backstop program, please don't hesitate to reach out to us. You'll have that information when the presentation is sent out. We have the backstop program, which concernly has a track, which I mentioned before, which deals with bookkeeping. And we provide guidance on the use of QuickBooks, and you get 55 hours of bookkeeping services through the course of 12 months. That might be beneficial to you. So reach out to us if you're interested. And certainly all of the things that Tom went through, you'll be guided through the backstop program.
Do you have a question? Hi.
Yes, Chilma.
Okay, so I wanted to just ask, like, what tools or systems does Tom recommend for keeping financial records, especially maybe when one doesn't have like an active accountant? I know
Yeah, you're breaking
you
up.
already answered this, but I wanted to also just ask how often should a small business? Okay.
Yes,
Yeah.
much
Is
better.
it better now? Hello? Okay. So my first question was for Tom is what tools or systems does he recommend for keeping financial records? I sort of answered this already, but I wanted to know, like, realistically, how often should like a business check through their records, especially with respect to maybe hiring, adding more people, and just having like an overall
Yeah. So, I
what the
have to be
business will look
somewhat,
like in like 6 months or a year. So that's my question.
yeah, I have to be somewhat, agnostic on recommending any accounting programs. I do know that there are a few popular ones out there, QuickBooks being one of them. um but you can run your business using Excel. It's obviously a little bit more complicated. I would recommend going and researching, there are a few different resources. I don't know if GNEC has any kind of special.
Yes,
um,
we do, as I mentioned to you, have the backstop program, and we get a lot of small business owners to your point, have used Excel, but then when they discover how powerful QuickBooks is and what they can do, and the program runs for 12 months, we don't expect the person to become a bookkeeper or accountant after 12 months, but certainly as a small business owner, you need to understand all the things that Tom went through, the P&L, the break-even point, cash flow. But certainly all of those folks utilize QuickBooks, and those that have switched over love it. It's a very powerful tool.
Yeah, I'd say many businesses start off with QuickBooks just because it's one of those very well recognized system. There are a bunch out there, but in terms of looking at how often to review your business, I think a year over year comparison at a minimum is important. Look at what you did this year versus last year. If you can include prior years, I don't know how long you've been around, but if you can include prior years, great. Because what it's really important to do is understand the trends. You know, in which direction is each line item going? And once you understand what's happening from one year to the next, maybe you can even break down, or at least in the future, start to look at how you spent your cash on a month by month basis. because then again, you can help establish those trends. You know, every 2 weeks you had to pay your employee. Every month you had to pay your rent. You know, those are all important costs that need to be considered versus, you know, how often does your revenue come in from your clients? So if you can get it to a month to month is typically you know, year to year and month to month are the two most common.
Also, for the participants, thank you all for attending. As Heidi mentioned, it's been recorded and you'll be receiving this information. Again, don't hesitate to reach out to us if you'd like to know more about GNAC and what kind of business support services we can provide to you. And also just remember that we also do provide small business loans. We do not provide lines of credit. We are not an SBA lender, but certainly would be glad to help you. Thank you all.
Thank you. Thank you, Tom.
Thank
Look
You're
forward
welcome.
to hearing this
Uh-huh.
again.
Bye, everybody.
Good. Thank you, Tom.